Greetings. We are together doing the finance module, which is module number 3. As we start this lesson, I'm sure you have the textbook that is the hands-on, written by Cecil Broer and Salam Votes. And this is on page 153. And you also have the textbook with you, the calculator, and the exercise book with you. The subtopic that we are going to do are the financial concepts. When starting with the financial concepts, we'll be starting by defining what the meaning of the cost price is. When we talk about the cost price, we talk about the price that someone pays for something that he or she is going to sell. So the second term is the cost of production. This is the cost to produce something without any profit added. Then we move to the fixed cost. What is meant by the term fixed cost or the concept fixed cost? This is the cost that stays the same every month. In other words, you pay the rent that is the same from January to November, not up until the owner of the flat changes the rent. And even if it changes, it will be the same for the next 1 or 2 years. That's why it is known as the fixed cost. Like the transport to school, you pay one and the same amount. Okay, the next concept is the income tax. What is meant by the term income tax? The amount that is calculated from your earning and paid to SARS. When we talk about the SARS, is the body that controls this tax in South Africa. It is known as the South African Revenue Services. Then we move to the next concept, which is UIF. What is UIF? It is the unemployment insurance fund that helps employees when the contract ends. It is always 1%. In other words, the employer pays the shares for you, a certain amount, which is 1%. You also pay 1%, so that when the contract ends, you go to the Department of Labor and claim for that. In other words, with our language that you used to say, it is known as the blue card. Most of the time, the adults say, I'm collecting my blue cards from the Department of Labor. This is known as UIF. Then the next concept is pay. It means pay as you earn. In other words, pay as you earn is the tax deducted from employees' salary. There are brackets that are used when paying tax. Not everyone citizen tax in South Africa is equal. The more you earn, the more you pay for the tax. The next concept is the personal income tax. What is the personal income tax? It is pay as you earn, paid on the personal income as pay as you earn. And then the next concept is the taxable income. What is the taxable income? It is the amount used to calculate income tax for an individual. Like I have explained before, that there are brackets that are used for different calculations to calculate the pay as you earn. And then the next concept is the tax rebate. What are the tax rebate? It's the money paid back to a person or business when there is an overpayment to a government. Maybe they've been deducting that you have been paying the tax, and then at the end of the day you have to submit to SARS. Then they'll calculate how much are you owing or how much are they owing you. When they owe you, it is known as tax rebate. And then we move to profit. What is profit? The profit, in other words, is income minus the expenditure. Then you get the amount which is positive. Let me say the income has been 1,000 rand and your expenditures are 800 rand. So it will be 1,000 minus 800, because 200 is not having a negative. So that 200 is the profit. Okay. And then we go to the loss. What is meant by this concept? Loss. It is the income. It is when income minus expenditure and the answer is negative. Like for instance, you'll get the income which is 1,000 rand and the expenses are 1,200. Then you say 1,000 rand minus 1,200, then you get minus 200 rand. In other words, that 200 rand is a loss, because you have set income minus the expenditure, then you got the negative. We move to the gross income. What is the gross income? It is the income before deductions. In other words, the gross income is the money that you get per month. If you get 1,000 rand, it is before deductions. It is your gross. And then we move to the net income. What is the net income? The net income is the gross minus the deductions. For instance, you'll get the gross, which is equal to 1,000 rand. Then the policies will be 400 rand, together with the money for the unions that are deducted from the employees. In other words, the gross will be 1,000 rand. Net income, it will be 1,000 rand minus 400 rand. Then that's, which is 600 rand, the answer. That 600 rand is the net income. Okay. Then we move to the break-even point. What is the break-even point? Is the point where expenses and profit meet. It is the point, let me say they are equal. The profit is equal to the expense. That is the break-even point. We move to VAT. What is VAT? In other words, VAT is 15% in South Africa. It is charged on the purchase price of goods, foods, furniture, cars, on whatever things that you buy. But there are those goods that when you buy, you do not pay VAT. That's why there is the VAT inclusive term. VAT inclusive is the price that includes VAT. And VAT exclusive is the price that excludes VAT. In other words, if they say the price excludes VAT, it's the normal price without the addition of 15%, which is the VAT. Then we move to the next concept, which is the interest. What is meant by the concept interest? Interest is when someone saves money at a bank. It is calculated in a certain percentage. Okay, we move to the interest rate. Now the interest rate is the interest paid and divided by the amount of the money that is in the bank, in the account that you have opened in the bank. Okay, so for this lesson, you have to read the concepts. They are on page 153, where you will find different notes concerning the financial concepts. You are expected to do exercise 3.1 to 3.2 on page 157 to 159 from the textbook that we are using for level 3. I thank you. That is the end for our lesson.